All right, good evening. So this will be a video on market review for the 5th of September 2024. So I gave an assignment on the Telegram group to identify the market maker model. Let me check. Let's be setting the exact. So the assignment states on your ES or US 500 for those of us using US 500, using your 5-minute chart, using your 5-minute time frame with a horizontal line, outline the smart money reversal, the first stage reaccumulation and the second stage reaccumulation. Post your chart markup. So the details from this assignment, it clearly states that we are looking for reaccumulation. A reaccumulation is the stages of the market maker buying model, meaning we're expecting higher prices. Why is that? Why were we expecting higher prices going into today's morning session after the 8:30 news release and the 10 a.m. release? So let's get right into it. So from the daily time frame, from the previous video on the mentorship, we noted the importance of top-down analysis and how impactful it is in your day-to-day trading, how it makes the lower time frame, how it reveals the storyline from the lower time frame and why it aligns with the narrative on the higher time frames. So we'll start from this. So here we have the daily. So on the daily, price is currently trading inside of this BC. So here we have a daily BC. So we currently drop down inside of a daily BC, and just below it is we have the daily BC low. And as you can see, these 3 consecutive up close candles, this was when the market was in a buy program offering higher prices. And when you have a market offering higher prices like this, and then you have a quick sudden energetic move down, this changes this state of delivery from a buy program to a sell program. Let's zoom in. So all of these 3 candles, from this candle, and this final candle from the 2nd of September's candle, they are all one candles. The algorithm sees this as one candle, and this set of candles, they were all in a buy program. So when the market changes its state from a buy program to a sell program, so this now is an order block. Okay, I see people calling this a CISD, change in state of delivery. Understanding an order block as a change in state of delivery, solely as a change in state of delivery, might interrupt with your understanding of this algorithm. I need you to understand that an order block is more than just changes of states of deliveries. In this instance, the order block here, the low of this candle, is the change, is when the market changes from buy program, then when it broke down here, to a sell program. If you identify this as a change in state of delivery solely and not as an order block, which it is, it might blow your understanding of what an order block truly is. There is more to order blocks than just being a change in state of delivery. But for this instance, it changes. The idea of it being a change in state of delivery is because it was in a buy program going higher, then on Tuesday's trading, we dropped lower, this energetic drop, making this from a buy program to a sell program. This is not buying pressure and selling pressure. This is the algorithm changing its state of delivery. All right, so enough for that. We'll cover more on that later on, but that's by the way. So here we have the daily bearish order block. Now this was the markup from the higher time frames, so we'll just go right straight into the lower time frames because this is a market review and we want to be quick with it. So why were we bullish going into today's trading? So on Sunday's opening price, we are currently below the Sunday's opening price, and from the lesson on markets on weekly profiles, we understand that when we are below openings, when we are below true opening prices, this is where we seek to enter buy position. We seek to enter longs from below true openings, and we seek to enter shorts below. We seek to enter shorts above true opening. This will streamline your accuracy and increase your strike rate because you are operating with a set of rules, a rigid set of rules. So here you have the Sunday's opening price. Right? So because the Sunday's opening price is above current market price during the New York morning session, so we had, first and foremost, you will note your openings, your midnight open and your 8:30 a.m. open. The midnight open is specifically to do with the London session, but it's also valuable when trading the New York session, and also the 8:30 opening price, when this is when the equities market starts trading. It's not the opening bell. The opening bell for the equities is 9:30, but we are more focused on the 8:30 open. So let's continue. So here we are the midnight. You can call this the 000 o'clock because from here it is when the market starts trading for a new day. 00. So here we have the midnight open, and then we had the 8:30 open here, which is just around the midnight opening price. So here we have the 8:30 open. Let's keep this away from each other. So you see, so when you come to the marketplace to trade the morning session, within from the 8:30 to 11 a.m., you note highs, you note the relative equal highs, you note buy side liquidity and sell side liquidity. So noting this as sell side liquidity. So below here we have sell side liquidity, which are sell stops. So let's call these sell stops resting here. So below here we have sell stops, and above this relative equal highs here we have buy stops. Also this high is lower than these highs. So when you have highs like this, when you have the first high lower than the second high here, price is likely to be interested in these forms of liquidity, like something like this. When you have this low being higher than this low, it means the algorithm is likely to come for these lows. So we are using this currently. You can still use this as, because the market came for these sell stops and also trades to these sell stops. So we are trading, this is just an eyesight review. Imagine all of this price action has not taken place from the 8:30 down to this time. So when you come to the marketplace at, so let's label these buy stops. So traders that entered early before New York session, they are looking for lower prices. They will enter their sell position around here and treat this as a resistance level. We do not operate in the traditional logic of support and resistance. So there will be stops placed here, above here, and whatnot. So these stops, they're already resting orders here. They are limit orders. So we are expecting the market to trade to it and trigger it to make it market orders. So the market does just one of two things: goes for a pool of liquidity or to balance an imbalance. So because we've purged sell stops here, we've swept sell stop here, we are expecting the market to go for buy stops. And from the narrative, from the higher time frames, from the top down analysis we just did now, we understand that we are currently below the Sunday's opening price. We do not, to be profitable, we do not need to get to the Sunday's opening price to offload all of our position. All right, so you are not to mark out the first stage distribution and the second stage distribution after understanding the smart money reversal. So after price took out this sell stops here, we had this smart money reversal here. I would want you to use the tool by the top left of your trading view to compare this market, to compare and construct the US 500 and the US 100. If you're using the indices contract, if you're using the E-mini contract, you will use the ES and the NASDAQ to check the correlation between these two markets. So when we had smart money reversal here, price rallied higher. From the video of on market structure, we note that when you have your J on liquidity, our J on liquidity was this daily bearish order block. This was the J on liquidity. You do not expect the market to get to your J on liquidity for you to be profitable. The road going to that J on liquidity, there are pools of liquidity and imbalances that will be left by the algorithm for profit taking. So you don't want to capitalize on this. So back to it. From the video on market structure, we noted that every time the market goes to balance an imbalance, that is an intermediate term low or an intermediate term high. So in this case, this is the intermediate term low. So you call this, so this smart money reversal here that took place, so this is the long-term low. So here you have the long-term low. And at these buy stops, you have the long-term highs. So you are going from a long-term low to target the long-term highs, which you have buy stops resting above it, and also this daily bearish order block. For a higher probability trade, you want to get at least two pool of liquidity for profit taking. So you have these highs here, you also have these highs here, you have these highs, and these highs. This has multiple criteria for it being a high probability low resistance setup. So this is a high probability low resistance setup. So when price rallied here after creating this low here, after taking out sell side, these sell stops which were resting below here, we rallied higher and left an imbalance, this imbalance at 9:05 a.m. This imbalance here, I'll employ you to note this imbalance, to study this after watching this video. So when this imbalance was rebalanced by this candle here, this now became an intermediate term low. So here is an intermediate term low. So when you have an intermediate term low that has balanced an imbalance, that went to rebalance an imbalance, you do not want that intermediate term low to be violated. This intermediate term low is the first stage reaccumulation. Does that make sense? Now you are incorporating the idea of the market maker models and market structure. This makes your understanding of the market maker models solid. This is me revealing my personal how I trade, my personal style of trading. I only see market maker models. I can read the charts candles by candles, but when I'm operating, when I'm executing, when I'm in the zone, let's use that term, I'm only seeing the market as a market maker, and I want to engage how the market makers will engage, and this is the idea of the market makers model. All right, so here you have the intermediate term, which is an IT, so you call it intermediate term low. So this intermediate term low, when this intermediate term low is created, this is the first stage reaccumulation. So here we call this the first stage. We just label this first. This video is taking longer than I would want it to be. So here is the first stage. So let us call this first. You can go practice all of this yourself, because this is an assignment already. This market review is already an assignment for the Telegram. So I don't want to explain too much. I want you to use your own personalized understanding of the market to engage in this, to engage in your learning, so that way you assimilate it and it becomes yours. The models, what aligns with your personality, the models that are here that does align with your personalities will be drawn to you, especially during parties. You can be buying at these lows when price was purging this, was taking out these sell stops here. This can be your model, taking out, buying below these lows here, or you're waiting for this expansion, then buying this other block which was created just at this, at sell side, buying this other block. Your model can be further you waiting for the first stage reaccumulation, which is this. Now let's continue. We noted from the video on market structure, which I think is episode 16 of the 2024 playlist, we noted that when the market goes to balance an imbalance and creates an intermediate term low, during that period when it goes to create that intermediate term low, it leaves an order block or a fair value gap. Not just that, but because in the hierarchy of PDRAs, those are top hierarchies. The order blocks and the fair value gaps, they are top hierarchies of PDRAs. You can make use of an immediate rebalance, you can make use of a breaker block, you can make use of a mitigation block, but for the hierarchy of PDRAs, the order blocks and the fair value gaps, they are paramount. The imbalances and the order blocks, they are paramount. But that's, by the way, if you watch the core content, I think month 4 or month 5, you understand what I'm talking about. So let's continue. So when an intermediate term low is created and makes its first stage distribution, its first stage reaccumulation of a market maker buy model, it leaves an order block or a fair value gap. Now, this is why I was re-emphasizing on you understanding an order block for what it truly is, and not just a change in state of delivery. There is more to an order block than just it being a change in state of delivery. That is one definition of what it is. But when you solely create your subconscious to think of that idea of it being like that. For example, something like this, when you have this up close candles like this, then when price drops lower like this, you'll be expecting price to come to this place to enter a sell position, you not knowing that price created a breakaway gap here and then dropped lower, making this a fair value gap, but a long fair value gap, which from narrative you won't want this to trade to the midpoint of it. But this, by the way, we're not focusing on the market maker sell model that took place here. That can be for your study. A student in the group, I'll outline this market maker sell model as the model is so. But we are currently focused on trading during the morning session before 11. The market maker sell model here did form before 11, but this was the one I partook in. So this is an inner musing or the inner thoughts while I was trading. So back to this intermediate term low. Now it leaves this order block, and now if you zoom in to this order block, you will see that this down close candle left this wick, this long wick. When a candle leaves a wick like this, a long wick, you are interested in the low of the wick and the high of the wick. So you take your Fibonacci and you measure the low of the wick and the high of the wick. This long wick, wick, W-I-C-K, my accent. Excuse my accent. So the midpoint of that wick now is consequent encroachment. Wicks are imbalances. So here you have the consequent encroachment. Let's call this CE, consequent encroachment. So when price trades back down into, after this expansion leg higher, when price trades back down into this consequent encroachment, you are buying, you are engaging for the second stage reaccumulation. So this right here is the second stage reaccumulation, which is an order block, the consequent encroachment of the order block wick. You see the complexities of this. This is why you need to understand almost all of the PDRAs. It's not like you're using all of it to trade, but you need to understand that when your model does present itself, it does not tell you what PDRAs is going to use. It can use an immediate rebalance, it can use a mitigation block, it can use a breaker block, whichever it wants. That is outside of your control. What is in your control is to understand your model, and when it does form, then you engage. So here you have the second stage reaccumulation. So here is the second stage reaccumulation of this market maker buy model, targeting these buy stops resting here, and also ultimately this daily bearish order block. Like I said earlier, you do not need price to get to this your daily order block for you to be profitable, for you to take something off. Another thing, you can, when you have pool of liquidities, like when you have target, first target here and second target like this, and it is wide as this, another profit taking method is to measure the midpoint of those targets. So if you measure the midpoint from this buy stops here to this daily bearish order block, the midpoint is fair value. So this midpoint here, you have fair value at this midpoint here. You can take something off here, you can take partials off. I cannot overstress the importance of you taking partials off. At the beginning stage, you can get complacent and think you taking partials will reduce your risk to reward model. Risk to reward is bullshit. There is no such thing as risk to reward. It's a myth. It does not exist. You only work with what the market provides for you. You only know your risk. Your risk is only what is determined. So say you're taking a long position from this first stage here, your stop loss around the midnight open, let's just say here, you're getting off your first partial around here. This is about 1.6 risk to reward. If you're taking more partials here, this is about 2.5. If you are waiting for the full pull to get to this is about 3.1, and this is close to 30 handles. You do not need 30 handles. If you can take 30 handles, you are done for the whole month. 30 handles is complete for the whole month. If you're trading the E-mini S&P, 30 handles is 30 times 50. That is about $1,500 in you are trading just one mini lot. If you're trading one mini lot, buying from year to year is $1,500. You are done for the month, especially if you're a new trader. But as you go into yourself and go into your model, you understand that $1,500 is change. So you might want to strive for more and probably go for more lots or more capital. So if you're taking from this second stage, your stop loss just below 3 PDRAs. So you look for 3 PDRAs and place your stop loss below that 3 PDRAs where you don't want it to be violated. The more you study, the more you understand yourself and your model, the more you understand where there is an invalidation point for you. All right. So you can use this idea of the market maker buy model and then transpose it to the market maker sell model that occurred here. From here, when you have this smart money reversal here, then price created this breakaway gap and then dropped lower. Then you have an institutional order flow entry below here, then price dropped lower. Then you see, this is what I said earlier, the markets will not tell you the PDRAs that will be left. It will just leave the PDRAs, and if you understand the stage in which the market currently is, then you execute. So here you have an immediate rebalance here. So here is the market maker sell model. This immediate rebalance is the second stage distribution, targeting this low and also going lower. The long-term jaw should be around here if we are going lower for the week, because let's take all of this off. So from your 15-minute time frame, so this is a swing trading projection model that I'm about to show you right now. So it's not necessarily for you. So if you take your fib from this high to this low here, and then you look for the standard deviation, so you look for the standard deviations, negative 1.5 and negative 2.5, you would have this. So this is a swing projection model. So if we are to go lower, this is the first jaw on liquidity, followed by this. You would have to correlate this with other PDRAs on the higher time frame to solidify this as the jaw on liquidity short term. All right. So hope you got something from this video, and I'll talk to you in the next installment of the mentorship, and have a nice day and goodbye.